So that's their obligation to pay back. Then it gets bigger and bigger, right? And then it gets bigger and bigger. And at one point, they were getting risk to get a margin call. This doesn't work. Hey, my name is Andrew. How's it going? We are gonna ask the very important question of, it's very nice that Ken helped out his friend Melvin. How thoughtful these hedgies are. I wonder if they'll be cellmates. Yeah, Mr. Gabe Plotkin, Mr. Kenneth Griffin, what are you guys doing? What exactly is Melvin Capital hiding with their 13F forms, and how exactly is this shaping out to be a larger bombshell than we originally thought? Citadel and Point72 purchased over 51% of Melvin Capital's share equity after Melvin's broker realized that they couldn't close their positions and complete margin call without risking bankruptcy. We know that Kenny G, Mr. Citadel CEO, helped out the Melvin Capital, Mr. Gabe Plotkin, original shorter of GME. However, now we are noticing a much larger trend, including a motion for Melvin to file a 13F form that essentially makes it so that they hide their positions from everyone but the SEC. So what exactly are they so darn afraid of? Well, we're going to cover that in just a hot second. Make sure to stay all the way into the end of the video and check out my surfboard, right? I am currently supposedly on vacation, and yet we're still working hard for you, getting news out there. So I wouldn't be too bashful asking a quick 1,200 likes on this video. If it's not quite up at 1,200, comment out which like you were, and then let's get going. Okay, they've been typing all day, sipping coffee all night, so strap in for a crayon drawings. Let's give a thumbs up to the source and description avid trees fan. Citadel and Point72 have owned at least 51% interest in Melvin Capital since January 24th through a private placement investment unregistered offering following Melvin receiving notice that their broker-dealer had margin called them. Let me explain. Not that I would think that they should read or trust Reuters or any other source for that matter, not even me, but they have an interesting source to evaluate since January. So here, Melvin Capital ends month with over $8 billion in assets after investors added cash. In the above article, it stated that a source, sus as SF, trust no one, disclosed that Melvin Capital ended the month with over $8 billion in assets. Traditional AUM reporting includes positions purchased with margin. So that $8 billion reported includes margin positions. It doesn't include short positions because a short's loss isn't realized until the position is closed. On the contrary, proceeds from a short position can be used freely to purchase positions that will be shown on AUM. There is a term called regulatory AUM, which means the amount of money of assets managed by a fund when accounting for losses in unclosed positions and tracks margin. But big surprise, funds don't offer this number publicly. And this is really, at the end of the day, if you guys are fighting for financial freedom, right, you guys are fighting for the chance to make your case and make a ton of money, you really should be fighting for financial transparency, right? Data transparency. Why don't we have the data we need to make smart decisions? Come on. What is going on here, especially the short positions that we want them to disclose? Don't miss the congressional hearing. That's going to be a fun live stream with yours truly, Andrew. There is also, okay, so we have this. There are two possibilities as of January 31st. Reuters source purposefully leaked the $8 billion number to suggest Melvin was worth more than $5.5 billion at the time of Citadel and Point72's combined $2.75 billion share equity purchase, or that $8 billion number is the amount of capital Melvin had after gaining access to more leverage using the $2.75 billion. If you remove the $2.75 billion infusion from the total of $8 billion it reported, it's 5.25. Exactly half of 5.25 is 2.62, meaning if Melvin raised funds at the valuation of 5.25, a 2.75 investment would be able to purchase controlling interest through a private placement investment. Okay, what is going on here? We know that Melvin had a certain amount of money, right? And let's just have this chunk. You guys can't see that because it's not being blocked here. Let's say that Mr. Melvin has this much money, right? And ultimately, maybe their GME debt, once GME got higher and higher, right? At the beginning of the day, their GME debt was this big, right? They could handle it, but GME started to grow in price. This is the price that they shorted it at. So that's their obligation to pay back. Then it gets bigger and bigger, right? And then it gets bigger and bigger. And at one point, they were getting risk to get a margin call because the value of which GME that they owed got so large that it encompassed their entire amount of assets that they managed. That means that they would have to liquidate everything inside of their hedge fund and then just to pay off all of the buying that they needed to do for GME. That's the short squeeze. That's what we were waiting for. And yet, when Mr. Citadel came over for Melvin's help, he added an additional 2.75 billion. Now is the question here, is this composite 8 billion enough to have a controlling amount of funds inside of Melvin Capital? So they believe that the $8 billion number represents Melvin's AUM after a 2.75 billion infusion and any margin they were able to gain access to between January 24th and January 31st. This would develop a narrative that Melvin did not have to sell controlling interest in the company to raise capital to prevent a bankruptcy. So we come here. Citadel and Point72 purchased more than half of the existing fund's share equity, and even unleveraged, that 2.75 accounted for 1/3 of the total assets under management as of January 31st. The links below will explain some of the nuances to private placement investments. Right? Feel free to be able to expand your mind when it comes to these economic terms. When purchasing through a private placement, the investor is essentially purchasing equity shares in that company. Owning more than 50% of a company's equity shares means that you have controlling interest in that company. Okay, so remember the January? It's only been a few decades ago, right? Between January 26th and the 28th, Goog fell from 1900 to 1830. Between 26th and 29th, FICO fell from 511 to 450. And between 26th and the 29th, Amazon fell 3,300 to 3,200. So we see the inverse correlation of larger stocks that, once again, right? We have all of this money that is going to be allocated to pay off their GME debt, which means that they need to sell their positions in other companies, Google, FICO, Amazon, right? We are looking at a clear direction when a company like a hedge fund goes and covers a big short position. This is not public available information unless they disclose it. But in the case of Archegos, right, and the case of Melvin, it's basically like they're going to leave a huge vacuum in the market for some people to try to jump in. But if you are a fan of the stocks that, like Viacom and Discovery, that Mr. Archegos left in their wake, you might know that they haven't yet recovered quite yet. Melvin has had big positions in all these stocks, and they think these drops are a result of Melvin Capital receiving a margin call, but they stayed holding positions acquired with cash. So there it is, the hidden margin call. I need to write that down as a title somewhere. I don't have a pen, but just so you know, I'll whisper into this piece of paper so Andrew will remember it later. Title this video, The Hidden Margin Call. Okay, got it? Take a memo. Okay, when a margin call takes place, the broker-dealer often uses software algorithms to close out the positions, meaning that a computer will literally buy any price within a specified range. They believe that this attempted margin call, they'll explain why they saw attempted margin call, contributed greatly to the buying pressure and run up to 483. Technical issues such as partial GME shares selling for over 2,000 may have resulted from this attempted margin call. Remember that Plotkin and Hearing said that he didn't think that price action was influenced by shorts covering. Plotkin is the CIO. Also, his grandfather founded Melvin Capital, so he is Mr. Melvin. I still believe that he knew that covering their entire short position would send the stock much, much higher and break the financial system, which we might have seen if the buy stoppage did not occur. So this is your one chance to be able to shake your hands at Mr. Melvin and Mr. Robinhood. Okay, there we go. As will take place when the mother of all short squeezes occurs, the broker-dealer, remember, we don't know where Melvin bought their shorts. It could very well be Citadel or another completely random broker who lent to Melvin would have had to decide to bankrupt themselves to attempt to cover and realize covering without going bankrupt was impossible. Only way to avoid bankruptcy was to require Melvin to locate adequate funding, and along came Citadel and Point72 to proactively contribute $2.75 billion to prevent further margin call of Melvin through private placement. So this is likely because whenever Melvin's broker lender realized that this was hitting the fan, they might have attempted to margin call Melvin's naked short positions on GME, only to realize that they literally can't cover it when a margin call due to unavailable float, since we now know the available float is 26 million. This is essentially the idea that there are so many shares that have yet to cover that recursively, nakedly, there are just not enough shares to cover, even if you try to margin call. You basically have to margin call and buy a bunch of shares, and when the robot's like, there aren't enough shares, we have to basically buy it back from the person we just gave it back to. That is a huge recursive issue. Okay, let's take a look. Reading that article would suggest that Archegos could have held a total portfolio of up to 100 billion because the lenders couldn't see that Huang was taking parallel positions at multiple times. So it also mentions that Credit Suisse took at minimum a $4 billion hit after margin calling Archegos, 4x their annual income generated by their largest sector, the real estate side, which shows why a broker-dealer may be hesitant to margin call since they can get burned really bad. So this is basically taking what we know from that margin call with Archegos into the fold of what we know has happened from this missing margin call, this hidden margin call that we have not been able to identify until it's starting to get pretty obvious. Here is the 13F form. I'll also include this in the description. It's the SEC form 13F for Melvin, Mr. Melvin Capital, which is disclosing that it does not want to disclose their positions publicly and only directly to the SEC. So if a fund that had $22 billion under management on December 31st, 2020 only had $8 billion after receiving a $2.75 billion cash infusion, from this, it can be observed that between December and January, Melvin lost a minimum $14 billion and could have lost well up to $16.25 billion total assets if that $8 billion includes leveraged gain from 2.75 from Kenny and Stevie Boy. In their opinion, 15 billion loss on a 22 billion fund sounds like a margin call to them, right? If you lose close to 75% of all of your money and you haven't been margin called, I think that you really kicked the bucket some way or another. So a little bit more in here that you guys can read, a couple more bullet points. Really excellent reporting from this user. Go ahead and make sure to show that source some love. And once again, thank you guys for supporting the show. I do appreciate it. My name was Andrew. We'll have Meatball back on the show next week. He's staying with some family right now. I am on vacation and perhaps I'll return to it. But for now, not for forever. Peace.